Good evening, everyone. Thank you so much for joining me. My name is Nikki Young, and I'm a financial advisor here with Northwest Financial Advisors, a wholly owned subsidiary of Northwest Federal Credit Union. And I want to welcome you to tonight's presentation of Directions. Is your retirement plan on track? A few compliance items before we begin. I want to be clear that this presentation is general in nature and may not address every single retirement topic. We will have a brief Q&A at the end to provide you with an opportunity to ask questions. However, in consideration of all attendees, specific, unusual, or complex inquiries are better suited for a personal consultation. Please also be advised that this presentation is being recorded for the purpose of sharing the content after the webinar, but all attendee questions and comments will be removed to protect your privacy. Please also note our required securities disclosure. So this presentation will be a review of the basic elements of a sound retirement plan. We will touch on cash flow, which is our savings versus our spending, how to manage that and find a balance between the two, insurance needs, saving and investing, what type of accounts are we putting our savings into, and how are we allocating that money from an investment standpoint. And then lastly, are we taking advantage of opportunities to be tax efficient? Planning for retirement can be overwhelming as we navigate the various factors over which there are varying levels of control. There are factors that are completely out of our control, like market returns, the future of tax policy, regulations, and of course, those are important things to evaluate as they change. However, the best way to achieve a secure retirement is to plan and spend our energy focusing on the factors that can be controlled. So we have longevity, how much we earn, how long we work. Those things are mostly in our control. And then there's how much we save versus how much we spend, and how we allocate and invest our savings accounts among the different, amongst the different accounts that are available to us. And those are the factors that we have complete control over. And that's going to be the basis for tonight's discussion. How you can take the things that you actually have complete control over in order to develop a sound plan to get your retirement on track. So retirement planning is one of the most, if not the most important part of our overall financial plan. But before we can begin diving into the factors that I just mentioned, we have to define what our retirement looks like so we know and have a clear direction to head in. And defining retirement answers questions like, when do I want to retire? As early as possible or never. A lot of people want to continue working later in life, but not everybody can. Nearly a third of retirees said that they retired earlier than they expected, primarily due to health problems or a disability, changes at their company, maybe a downsize, or to care for a spouse or a family member. So if your objective is to retire later, it doesn't hurt to consider what your backup plan would be if an unforeseen event does happen. Then you can strategize on what changes would need to be made, if any, to make your portfolio last as long as possible. Next is, will you fully retire or work part-time? It's very common that individuals will fully retire from their primary career and then decide to work part-time or start a business. And that's because people desire to stay active, stay involved, or just enjoy working. So those first two questions are going to help to determine our timeline, which is how long do we have to put this plan together and then put it in motion. But the last question, how will your time be spent, is interesting because retirement offers the gift of time to do the things that matters most to you. So I would start thinking about what that is and what's most meaningful, because if you've been working for decades and then all of a sudden you stop working and that routine changes, you could find yourself spending time and money on things that don't really leave you satisfied. So it's best to have some idea of what's going to be happening after you transition. So once we've determined all of that, we can get a sense of how much money we're going to need in order to be fulfilled, which is the starting point for funding our retirement. You should look at what sources of income you're going to have coming in. Does that meet your income target? And how long will you need it for? Because the biggest risk to all of us in retirement is running out of money. Which brings us to life expectancies. Everybody should count on longevity. I've heard it so many times, where people will say, I don't think I'm going to be around that long. My parents didn't make it to their 80s, so I'll probably pass in my 70s. And I'll say, okay, well, how old are you? And they'll say, well, I'm 65. Hold on, wait a second. So you're telling me that you're healthy, you're active, there's no major medical issues, but you've only got 10 years left max? Maybe we should take a step back and talk about this a little bit more. And if there are health concerns, then I absolutely get that. I'm sensitive to that, and we plan for it. But if not, everybody should plan for longevity, perhaps as many as 30 plus years in retirement, depending on when you actually retire. So, what this chart shows, for example, is if you are a 65-year-old man, then there's a 63% chance that you're going to live to be 80, a 44% chance that you live to be 85. If you're a 65-year-old woman, there's a 73% chance you live until 80 and a 55% chance you live until 85. Women tend to have a little bit longer life expectancy. And then for couples, longevity increases even further. That's the green bar. So there's a 90% chance that at least one partner in a couple will live to 80, and nearly a 50% chance that one will live till 90. So when you begin your retirement planning, it is a best practice not to underestimate how long you're actually going to live. Moving on to cash flow, which is really the heartbeat of any financial and retirement plan. We have to understand and manage our cash flow. Cash flow means what you have coming in versus what you have going out. When you're working, you have income from your compensation, which is your paycheck, and you may have some income from your return on investments. Now, when you transition into retirement, your income structure shifts and it may consist of a pension, Social Security, and then there's the money that you have saved in retirement plans like a 401k, the TSP, or an IRA. Now, outflows, which is what we're spending, that may or may not decrease in retirement. There's a rule of thumb that says that you're going to need about 80% of your pre-retirement income when you retire. And that's not a bad starting point for planning, but you really need to take a look at what your expenses are going to be in retirement and if they're really that much different. Your mortgage may or may not be paid off yet. You could still be renting. And regardless of either of those two, we still have to pay property taxes. We still have to pay utilities. Daily living expenses may increase in retirement. They typically do as we have more time to travel, spend with our grandkids, and pursue hobbies that we may not have had the time to commit to before. And I know it says daily living expenses, but it could say daily living wants. You think that just because you're retired, you're not going to want a new car or some new clothes. So those are expenses that we do need to account for in retirement. Now, medical expenses and our insurance premiums typically increase as we get older. Now, and retirement savings is really the one of the only things that generally stop when we're retired because we're no longer in that saving mode. We're now in, the spending mode. So when we look at our inflows versus our outflows, what we generally want to see is a net positive, meaning our income is more than our expenses. If your net cash flow is positive, then you're probably in a good place. If it's negative, then that's an opportunity for you to reevaluate your money management strategy. Take a look at your expenses and how you could possibly reduce some of them, and take steps to shift your cash flow in a more positive direction. So I know that sources of income in retirement had pensions on there. And a pension is an income stream that's paid to you by your employer when you retire, and it's paid to you for the rest of your life. But access to pensions have gone down substantially over the past years. Now, if you're a federal or state employee, it's much different. Or you may be fortunate enough to work for an employer that still offers a pension. But the latest stats on pensions says that only 39% of the baby boomer generation have access to a pension. It drops to 24% for Gen X and only 16% for millennials. So, what that means is younger generations own a greater responsibility for saving and planning for their own retirements than older generations. So, it's something to keep in mind. And then there's Social Security. Social Security, it's a really important benefit that adds to our cash flow in retirement. However, it is not meant to be your only source of income. For most, you can claim Social Security between the ages of 62 and 70 years old. If you were born in 1960 or later, your full retirement age is 67. And that's the age at which you can receive your full unreduced benefit. If you file for Social Security earlier than 67 or your full retirement age, your benefit is going to be reduced and it's reduced for the rest of your life. But on the flip side of that, if you delay taking Social Security until, let's say, you're 70 years old, your payment will grow and be higher. So there are several factors to consider when making the decision on when to file for Social Security. It's such as, do you need the income? Do you have longevity? Are you still working? And what does your spouse's Social Security situation look like? And Social Security benefits are up to 85% federally taxable for certain individuals. So, what I recommend is start by creating an account on SSA.gov. You review your information. You can download your Social Security statement. It will tell you the amounts of that you can expect to receive at the different ages. And then, of course, consult with the financial professional on what makes the most sense for your unique situation. Also, be on the lookout for our comprehensive Social Security webinars. We did one earlier this year that should be available via our website, and we'll likely do the same next year where we take a deeper dive into Social Security analysis and the implications for your retirement on when you decide to file. Insurance. Insurance is a tool for protecting your assets and managing risk, and it's really important because without it, any catastrophic events can really derail your retirement plan. There are several types of insurance that are worthy of consideration, and I'll start with life insurance because it doesn't get any more catastrophic than loss of life. So while you're working, your employer may offer life insurance, typically known as group life insurance. But when you retire, that stops unless you're a federal employee and you have some options to continue coverage under FEGLI. But in general, you stop working, so then your insurance coverage stops or your life insurance coverage stops. And when talking about life insurance, there's two types. There's term insurance, which is in force for only a specific amount of time. You may have a 15-year term, 20 or 30-year term. You pay for that long, your coverage for that long, and then once that term ends, the insurance ends. And then there's permanent insurance, which is in force for the rest of your life. To evaluate your life insurance needs, it's pretty simple. We look at if you were to pass away, would your loved ones be taken care of? Do they have enough income or enough assets to maintain a certain lifestyle? If not, then you might need life insurance. But as we move towards retirement, assets typically increase and our debts typically decrease. So we have less need for life insurance. And frankly, the money that you're spending on it could probably be put to better use for something like long term care, which I'll discuss shortly. Then we have health insurance. Retirees become eligible for Medicare at 65. If you decide to retire before then, and you don't work for an employer that offers continuing coverage, then you may need to bridge that gap to help cover the cost of medical expenses. And it's so interesting because a lot of the times when we're working and we actually have the coverage, we're so busy, we put off or even neglect, if you will, going to the doctor and resolving our healthcare issues. Then we retire, realize how much pain we're in. We've got the time. So then we decide it's time to go, and our expenses go up. And this is a common challenge. 70% of Americans retire before they become eligible for Medicare. So part of your plan should address how these expenses will be insured until your Medicare coverage kicks in. With liability insurance, it's generally just a necessity to continue our liability insurance into retirement. So that's going to be your auto insurance, homeowners or renters, maybe even some professional or umbrella insurance. And then lastly, long-term care. And I know it's draining to think about death and nursing homes, but this is one of those things that can really derail your retirement plan if you don't plan for the possible need of long term care. So at age 65, the likelihood of needing assistance with two or more activities of daily living is 75% for women and 64% for men. And so, what are the activities of daily living? Bathing, dressing, eating, toileting, pretty much all the things we would never want anyone to help us with. But the reality is that there's a high chance that we will need that type of care later on in life, and we should have a plan for that care and a plan to cover the cost, because the cost of this type of care, it can really be staggering. In Virginia, the average cost of home health care is about $43,000 a year, or $27 an hour, depending on how many hours you need that care for. And then when you start talking about nursing homes, it can be three times that amount. So, one way to cover those costs is to self insure, meaning you're the one writing the checks. You're either using your retirement savings or cash savings, but that's going to impact what you have left down the road, especially if your goal is to leave a legacy, or, I mean, it could be the money that you need to live. So there may need to be something besides our own savings in place to help cover those costs. And that's where long term care insurance comes in. Now, previously, long term care policies were these standalone policies that were really expensive, they cost a lot of money, and if you never used it, then all those premium dollars just went to no use. The long term care insurance market has shifted in recent years, and there are some neat coverage options available for individuals, surviving spouses, where, excuse me, where even if you don't use the long term care benefits, all is not lost. And you can recover some of those premium dollars in the form of a death benefit to your beneficiaries. So it essentially acts like life insurance. So the key with all of this insurance is to understand and evaluate what insurances that you need, what you don't need in terms of coverage or options, and that's going to help reduce your risk of financial loss and minimize the impact to your retirement plan. Now, let's explore the many ways in which we actually save for retirement. We have employer sponsored plans such as 401ks, 403bs, the TSP and the VIP. Now, those two, the TSP and the VIP, are only available to government agency employees. But then we have the IRAs, traditional and Roth. And then other investments, you may have some non retirement investments or maybe some real estate investments. And as you are building your retirement portfolio, my hope is that you're also investing the money that you're putting into these retirement plans. How you're invested should be based on your objectives for retirement, how much money you need to achieve those goals, your time horizon, because someone who is 30 years away from retirement should probably be invested differently than someone who's 3 years away from retirement. And finally, your risk tolerance. Volatility, which is the ups and downs of your portfolio, it is a natural part of investing. And while volatility can present an opportunity, I understand how difficult it is to experience in real time. So, risk tolerance is how much volatility can you take before you reach that breaking point. Now, all three of these factors, objectives, your time horizon, your risk tolerance, they need to be carefully coordinated in a way that gives you the highest probability of a successful, dignified, and independent retirement. Retirement savings plans. So the 401k and the TSP are both tax qualified defined contribution plans, meaning that it is funded by the money you set aside from your paycheck. And the retirement income that you can eventually receive from those accounts will depend on how much you put into your account during your working years and the investment earnings that have accumulated over that time. Matching contributions also make a difference. A lot more employers are offering matching contributions, which add additional retirement savings into your account as well. These accounts are considered tax deferred. And how it works is your contributions reduce your current taxable income. So you get that tax break now. You don't pay any taxes on that money now. And then in retirement, when you begin taking distributions, they're fully taxed at that time at whatever tax rate you are then. Now, you may have a Roth option within your 401k. This is another option that more and more employers are starting to offer. And I know that there's definitely a Roth option within the TSP. So these contributions don't lower your taxable income now. So there's no immediate tax break. However, in retirement, qualified distributions are tax free. And please don't confuse Roth 401k with Roth IRA, which I'll discuss on the next slide. But I want to address a common misconception there. There is no income limit on Roth 401k contributions. So even if you are bringing home an $1 million salary, if you have a Roth option within your 401k or your TSP, you can fund it. So I recommend checking your 401k plan documents or asking your HR admin if this option is available to you, because it could be a great way for higher income earners to take advantage of the tax-free nature of Roth accounts. But I understand where that misconception comes from because IRAs are different. And what we have here is a summary of the two main types of IRAs, and IRAs are commonly referred to as individual retirement accounts. So both types of IRAs have tax advantages, and I'm going to put emphasis on the tax advantages over the next two slides or so, because it's for tax efficiency, and it's really important to understand the differences and how they work. So with traditional IRAs, your contributions may be tax deductible. Typically they are, so you're getting that current tax break. Hopefully you're investing that money and your earnings grow tax deferred. And then when you withdraw from the account in retirement, you pay the taxes then. Traditional IRAs do have RMDs, which are required minimum distributions, because this money and the traditional IRA money, it's never been taxed. So when you're 72, when you turn 72, the IRS makes you take a certain amount of money from your traditional IRA and pay taxes, because otherwise, depending on your income situation, some people would never take any money out of their traditional IRA. So the IRS definitely wants to collect those tax dollars, hence RMDs. So with a Roth IRA, there are income limits on contributions. So if you make a certain amount of money, you cannot contribute to a Roth IRA. Now, there are strategies to get around that. It's beyond the scope of this presentation, but just know that there are strategies available for higher income earners to have Roth dollars. Roth contributions are made after tax, so there's no immediate tax deduction. But when you withdraw from that account in retirement, you're getting that income tax-free. And there's no RMDs, no required minimum distributions on Roth IRAs. So when you're making the decision and trying to decide between which type of IRA to fund, we look at factors like your age, your current and potential future income, and then your desired tax objectives. And please note that these type of accounts, IRAs, they're not employer-sponsored plans, so you're not going to go to your employer to establish an IRA. IRAs are typically opened and managed by either a qualified financial advisor or self-managed. Now, this chart puts emphasis on the tax differences between both traditional and Roth contributions. And what I like about this breakdown is the breakdown of how it affects your paycheck, because that's really important. With traditional contributions, since you're getting that tax break now, you're not paying the taxes now, so you're getting more of a net pay. You can transfer to and from eligible accounts, and then you pay the taxes when you withdraw the funds. With Roth contributions, you're paying the taxes now. So more money comes out of your paycheck, which results in a lower net pay. Transfers are allowed to Roth accounts, and when you make qualified distributions in retirement, you're tax free. Listed here is what makes a distribution from a Roth account qualified. You must have had the account for 5 years, either be 59 and a half or older, permanently disabled or deceased. There are a lot of individuals that contribute to both the traditional and the Roth, especially within their 401k or TSP. And the money is typically kept in separate traditional or Roth buckets. So it's easier to keep track of your contributions and the transfers within your account. So there is a benefit to saving and investing early over a long period of time. And this chart compares the different retirement outcomes of 4 different savers who save the same amount per month. They all save $200 a month, but at different times in their lives for different durations and with different investment choices. So I'll start with Nervous Noah in the green, and I did not come up with these names, but so Noah saves from ages 25 to 65, but he saves all of his money in cash, earning 2% over the entire time period, and he ends up with the least amount of money. Then we have Quitter Quincy, who only invests for 10 years from age 25 to 35, but is invested in the market, earning a decent 6% return, ends up with a little over 200,000. Now, what's interesting with late Lila, she invests from ages 35 to 65. So started a little bit late and earns the same return as Quincy, and they end up with the same amount. And Quincy only saved for 10 years and Lila saved for 30. So it just goes to show the benefit of having more time to allow your account to really capture the full power of long-term compounding. And then we have consistent Chloe. Now she saves and invests consistently over the full time period. And when she reaches age 65, she has more than double the amount of the other savers. Now, here's the thing. Saving and investing early, yes, it is the best thing to do in theory because it allows you to save less amounts over a longer period of time and still get good results. But starting to save later is not the worst thing. It just means that you may have to save more in order to reach those goals. When it comes to savings rates and how much you should save, although it will be different depending on your goals and where you are in your saving journey, a good rule of thumb is to save between 10 to 15% of your income for retirement. And that includes employer matching. So if you're saving 10% and your employer matches 5%, then you've hit that 15% mark. Investing for retirement. How we invest our savings can have a significant impact on our ability to reach our retirement objectives. These are the most common asset classes that make up most of our investment choices. We all know cash, fixed income, which refers to investments like bonds, equities, which are stocks, and then there's real estate, and commodities, which are materials like energy and metals. Now, the way in which we position these different asset classes within our portfolio is going to be the primary driver of the performance over time. Our portfolios tend to be made up of the 3 primary asset classes, which are stocks, bonds, and cash. In general, The longer time that you have and the farther out you are from retirement, the more your portfolio should hold in stock because they're the asset class that has the potential to generate the highest returns over longer periods of time. As you get closer to retirement, adding bonds can help smooth out short term ups and downs in the market while still providing growth opportunity because you want that over a retirement that could last decades. Fixed income or bonds, they have lower returns on average, but less variability, especially over the intermediate term. And then cash has the lowest average returns, but the least amount of variability. Your balance won't ever change. Diversification. And diversification within a portfolio, it's simply not putting all your eggs in one investment basket. I know this chart is rather busy, but the message is that rather than trying to determine which asset class is going to perform the best, diversification involves spreading your money across different investments, different asset classes, so that way your portfolio is not never too dependent on one type of asset. Over time, the ups of one investment have the potential to balance out the downs of another, with the goal of reducing the overall risk level in your portfolio and maximizing returns. It's commonly said that 90% of our investment success is determined by asset allocation and diversification, not choosing specific individual investments. So now I did mention market and investing volatility earlier in the webinar, and I know that given the year that we have had thus far, it's hard to not feel anxious about it. We can have a great, diversified, well-constructed, long-term portfolio, but if we don't stick with it when things get uncomfortable, it's going to be hard to realize our full investing potential. And I'll pick on, my federal employees out there that are 10 to 15 years from retirement, but just moved all their money into the G fund. I know there's probably a few on this call, and I'm just picking with you, but I want everyone to know that as advisors, we hear your concerns and emphasize with the emotional toll that this takes. But the reality is that markets are volatile and they fluctuate often. It is an unavoidable part of the investment process. And so, what this chart shows is that volatility each year is normal and it's routine. And I would even take it a step further by saying that it's good and an opportunity and necessary. But so even in positive calendar years, one should expect the market to experience a significant correction at some point throughout the year. According to this data, from 1980 to 2021, 29 out of 39 years, this is what happens. That's been the case. If we look at 2020, we ended the year with a 16% gain, but we also had a pandemic and saw a 34% decline that year. So, what I would recommend is get your portfolio evaluated and make sure that it's invested in the best way possible for your objectives. And if you have that, then doing absolutely nothing during periods of volatility can be the most impactful action you take. The impact of being out of the market. So, when you make the decision to cash out when returns are low and volatility is high, it could have a costly impact to your retirement plan because once you sell your investments, you have to make another decision, which is when do you get back in the market? And the thing that gets people is once you're out, it's hard to convince yourself to get back in, especially in the near term. Investors typically wait until the market is back at its highest to jump back in. And then, in addition to that, selling out of the market after the worst days is likely to result in missing the best days that follow. So, if we look at this graphic from 2002 to 2021, 7 of the best 10 days occurred within 2 weeks of the 10 worst days. 6 of the 7 best days occurred immediately after the worst days, and the second worst day of 2020, March 12th, it was immediately followed by the second best day of the year. And there's a cost there. There's a cost to missing the best investment days in terms of your portfolio balance and returns. If you look at the performance of a $10,000 investment during that same time period, by staying fully invested, you end up with a little over $61,000 and a 9.5% return. The more days that you miss, and as you start to miss more days, not only does your portfolio value decline, but then your returns dwindle and then end up turning negative. And that is how a narrative is created that investing doesn't work or it's not worth it. And that's just not accurate. So plan to stay invested. Trying to time the market is extremely difficult to do consistently, if at all. Market lows, they often just spark an emotional decision making on part of the investor, and that's when it's beneficial to have a trusted advisor that can help put things into a clearer perspective. And of course, there's a Warren Buffett quote for everything, right? So he said, investing in the stock market is a way for the impatient to transfer money to the patient. So try to invest for the long term. Have a strategy for managing volatility, and that's going to result in a better retirement outcome for you. The 4% rule is another rule of thumb that's about how much can you spend from your portfolio and without running out of money. And 4% is the maximum initial withdrawal percentage that has a high likelihood of not running out of money after 30 years. This data assumes a 40-60 investment portfolio, which is 40% equities or stocks and then 60% bonds. And the 4% rule, it is successful for 30 years, but it may not be that, successful for those of us with greater longevity. There's a higher risk of running out of money the longer that you have to, the longer you need that money for. So the bar graph here in green shows how the 4% rule has performed in the past. And if you look at it, it's actually not that bad. 1 in 4 investors, 25%, have had 5 times the amount that they started with at the end of retirement, and this is based on a portfolio value of $1 million. So five times the amount that you started with, 25% chance of that. And now that may be a positive outcome if your goal is to leave a legacy. It may be a poor outcome if you've had to make lifestyle sacrifices in order to keep spending low relative to how the portfolio performs. But there is an 85% chance that you're not going to run out of money. Now, this withdrawal rate is not going to work every year for everyone. You should consider a dynamic approach that adjusts your savings over time to more effectively manage that. The inflation factor, I would be remiss if we didn't speak about inflation. Inflation is a key element of future financial planning and can be a silent killer of retirement wealth, although, these days it's not so silent. I would encourage you not to overlook the impact of inflation on your savings and your investments. With current inflation at 8% and even average inflation around 3%, if you have everything in the G fund or everything in cash, you're actually losing money by keeping it there. Even though markets can be scary, it's best practice to take the bad with the good and position our money to grow enough to stay ahead of inflation. By not doing that, you're eating into the value of your assets and increasing your future costs. So I do have some action items that I would like to share with you because it's not going to take a miracle to achieve financial security in retirement. These are immediate steps that you can take in order to be headed in the right direction. First, start saving, keep saving, and stick to your goals. It is never too late to start saving for retirement. I don't care how old you are, how little you've saved so far, just get it started. And even if you can't hit that 10 to 15% mark right out of the gate. Start with what you can, and then as your income increases, you can build that up until you hit the target that's appropriate for you. And when I say stick to your goals, I don't mean that your goals won't change over time. They may change often depending on what life throws at us, but allow your goals to keep you grounded when things seem uncertain. In addition to retirement savings, it is important to have an emergency fund that's liquid and easily accessible for when you need it. And if you're saving in an employer sponsored plan and your employer offers a match, try to capture the full value of that match. You don't want to leave any money on the table, so try to capture that full employer match. Secondly, evaluate your retirement income needs and define your retirement so you know what you're retiring to and not just what you're retiring from. And then lastly, ensure you're properly invested with a diversified and growth oriented portfolio, and then stay the course. In closing, I'm going to share the Northwest Financial Circle of Financial Life. Tonight, we briefly covered cash flow, asset management, risk management, and tax efficiency as it relates to your retirement plan. However, retirement is just one aspect of your holistic financial plan. There are firms out there that hang their hats on investments. That's all they want to discuss. At Northwest Financial, we are not stockbrokers tasked with buying and selling stocks. We feel that in order to be doing a good job for our clients, we need to touch on all of the items that you see here that make up your life and have a thoughtful investment process to go along with it. We provide comprehensive wealth management to help our clients accumulate, preserve, and protect their assets, as well as putting you in the best position to succeed however you're defining success for your life. With that said, we at Northwest Financial Advisors would be happy to help you with your retirement decisions as a part of your holistic financial plan. At the conclusion of this presentation, you will receive a survey. Your feedback is most appreciated, but you will also have the opportunity to request a complimentary consultation with myself or one of my colleagues. We have advisors that take appointments at many of the Northwest branches, and you'll be able to specify which location is most convenient, including virtually. And so that is going to conclude the presentation portion of tonight's webinar.